All right. Good morning, everybody. So we're looking at Bloomberg right now. One of their articles is looking back at the supply chain issues, which is starting to come back up again. Every time you hear any talk about lockdown in China, this should be the first thing on your mind when it comes to trying to anticipate or identify how a lockdown in China would have any bearing on our market whatsoever. Looking at the news through the European markets so far, not too much. Nothing really stands out that's exasperated or concerning. A lot of the market right now is just waiting to see what goes on with a couple of the FANG names that report. They are going to make and break our market if they don't have a good earnings. It will be the catalyst that finally tips this sucker over. Says it again here. I'm sure there's a lot of articles out there right now. Apple is likely to dictate the fate of big tech in a busy earnings week. It's not just Apple, man. It's Apple, Microsoft. There's all kinds of names. One thing I wanted to point out from yesterday, the S&P had that nice V bottom off of the lows. Well, it wasn't much of a V bottom. I mean, we were kind of range bound anyways, but we had that raid down into the lows and then we rallied back up. Happened on the Nasdaq too, right? We came up off of that low right around noon, and it was hard to trust it, right? Other than the fact that we kind of went from, high to low, back to high to low, a little bit lower, and we started working our way up. Your first instinct should have been at least to think that we could get back to the previous point, right? And then we went beyond that. We went through previous close and we actually closed above that. Look at the Russell crossover. It's the green line here. Now, I've pointed this out before. Um, and of course, no signal is perfect. But when you have a day where the indexes are all kind of clustered together and then suddenly the Russell breaks away from the crowd and starts to run, that signal is very often a confirming signal that we're getting a change in market sentiment. It's not an isolated thing. You wouldn't want to just look at that and just go buy a call, but it's one more confirming piece. And this is not like going and looking at the IWM or the RUT. Don't go look at the Russell. That's not the point. This is a cumulative tick comparison. It's comparing the cumulative tick in the Russell to the cumulative tick in the NYSE and the S&P and in the Nasdaq. When we designed this indicator, we didn't know it was going to be like this. We didn't know the Russell signal would mean anything. We didn't even know there would be a Russell signal. We've just noticed after using this thing, and it's been built now for a couple of years, we use it constantly. When you get this Russell crossover signal, when that green line breaks away from the crowd and starts to run, it's a confirming signal. I posted that signal yesterday, and there was plenty of time to, ask questions on it, because that's what we want to do, right? We see the signal, start asking the market questions. Is it going to stick? Is it going to hold? Is there any flow that can validate this? What's going on in the other indexes? What's going on in the regular tick? If you notice when that crossover happened, we had been maintaining negative ticks. We were in the red. We were closing below minus 500 all day long, all morning long. And we were just whipsawing back and forth from red to green, red to green, red to green with these deep moves below minus 5. When we got that crossover, all of that stopped. Sure, we were still coming back and dipping down into the red, but we were no longer crossing below minus 500, and we had more in the green than in the red, right? It's not a perfect thing when you're looking at tick. Tick is just like a violent thing, just whipping back and forth. And I'm on a 1 minute here. Maybe adjust that to a 5 minute. But we came across and stayed more in the green after that. Another signal, right? None of these things would give you 100% assurance that, yes, you should absolutely go out and put money into the market. No, of course not. You're not going to get that kind of stuff. But it was just one more confirming signal, right? And a very valid one. If you want to learn more about this indicator, or if you want this indicator, it's in the Discord. The Discord is the link for it is in the Bullish Bears Discord. So you need to go to the Thinkorswim workbook. It's a market breadth indicator. So look under market breadth. I also wrote a blog post on this thing back in like, I don't know, 3 years ago. You can find it on the Bullish Bears website. Just search for $TICK. You'll come up with it. All right, you can see we got a lot of things on the list today. 8:30, 9, 10, 11, and then 1. So every hour on the hour, all morning long, we've got more news and more news and more news coming out. And then we have additional auctions at 11 and 1. Those additional auctions are game changers. They can absolutely rewrite our entire day. Notice where that change in sentiment came in yesterday. Right? It's right on the backside of lunch. It's not a coincidence. Look at the clock. Look at the time frame. When you go back and you're studying the way the intraday charts are moving and you see breakouts and reversals and complete change in market sentiment, look at the clock time frame. Where did it happen? On the hour, on the half hour? Any of these today, not the auctions in the later part, but in the morning, they have the capacity to knock our market down or lift us up. I think they're going to be muddy waters. I don't think they're going to be clear or clean. I don't think the message will be unified to drive us in one particular direction. So it's likely to be a lot of chop. And I don't know if they've got enough in them to get investors engaged while they're still waiting on the fangs to report. But just be aware of the time, watch the clock. And I pointed this out yesterday. It's worth noting when the indexes have a gapped down day and then they rally back up, that used to be or usually is a signal of a bottoming pattern. We didn't gap down here per se, but that mega drop and then rally back up. The deeper the drop, the better. Looking for my signals. I know I had some. Since the ES is open all the time, maybe it's better to find that signal over here. There it is. All right, so this was one, and that was a failure, right? You can see how we closed at 422. We opened up at 411 and rallied just absolutely crazy. That's one of those days that set records. So we had that. There's been two or three of these. Yesterday, for an example, the same thing. We opened, gapped down, dropped even more, rallied back up into the close. We've been getting quite a few of these, and they're not following through the way that they normally would, right? That's kind of the takeaway. Normally, not counting this year, when you get this signal, it's a very good signal of a bottom, and you got to check the volume with it. There's a couple other parts and pieces, but that's generally a really good signal, and it has just not had the follow through that we normally would. Right, this one right here with all the volume and everything that was with it, that really, I mean, every place was talking about how much that was like, there's our signal, and nope, it didn't work. Right, then the trend line breakover when the Fed came out, there was like the micro breakover on the day that they did it, on that Wednesday, and then the bigger trend line breakover, as it stuck for the rest of the week and then into the next week, and all of that fizzled out. So the signals have been there. They've been very good, clean, clear signals with just no follow through. All right, so we're out on the higher time frame. We're looking at a yearly chart. Just want to come out and take a peek. You never know if there's something there or not unless you go out and look. If you never look, I guarantee you will never find anything, right? Maybe you look and you don't find anything anyways, but at least you looked. There's nothing out here this morning. Just wanted to come out and take a peek. There was a discussion yesterday if we were going to focus more on, the immediate swing high, swing low, or if we were going to focus on the existing higher time frame. And if we back it up to our discussion from yesterday, we were sitting right about in this point right there, and we had our low, high, low, and we were looking at a high yesterday, right around this time. And there was a discussion of, well, if we start getting higher highs and higher lows from here, then we would just go ahead and invalidate that, and we would focus on the rest of the swing high and swing low. And this turned out to be a 3% move, and this turned out to be a 3% move. As usual, equally given on each side, right? Set the low, set the high, set the low, set the high, low, high, low, high, low, high. When you got the extreme on one side, you very, very often get the extreme on the other side. Matches out. We got a very, very narrow initial balance, meaning that there is the capacity for a lot of work to be done. They have not yet accomplished their task for the day. Three things we can do, right? We can hold the range, we could break to the upside, or we could break to the downside. This is a very narrow, very muted range. I find it very hard to believe that we would hold our Globex range, but we could hold the high at Globex and the low of yesterday, which would still constitute a range. That's the range that I would define if we're going to talk about a range day today. And it's very likely that we maintain between 4,300 and 4,200. That range is pretty high on the list of probabilities. So that scenario is simple enough. Talk about a downside move. Well, we're down 0.5% this morning. If we were to focus on more negativity, we would first want to see a market break below our own Globex low, deal with yesterday's uh, open, deal with yesterday's Globex low and yesterday's RTH low. And then at that point, define where we're at. Right. So that would get us down to a 1.3 more from our current location. So it'd be about 2.3, 2.2 ish. So a 2.25% move just to get down to yesterday's low. If we were to get that far alone, it would be extreme considering, the ADR right now and the idea that we've already used up a good 12 hours of our day. The ADR is 1.7. So we could see a break below yesterday's low. I find that unlikely, though, unless there's a really good amount of news that comes out and galvanizes us and pushes us like that. Um, you should see all the markets negative. You would see all the sectors negative, maybe something like utilities or energy dragging its feet, but otherwise finance and tech would be negative. Junk, emerging markets, all those kind of markets would be really negative. VIX spiking. It would not be subtle, right? We're talking about seeing the market make a 2.25% move from its current location and breaking below yesterday's low before the end of the day. That would be a pretty extreme move. It's doable, which is why we're talking about it, but it wouldn't be subtle. It wouldn't be like yesterday afternoon where we got that late afternoon rally with the chop and grind in it. And it would be very lit up, right? Everything out there. We'd have a very correlated market, very extreme moves to the downside. So that one won't sneak up on you. For the upside, we'd first have to get back our own Globex high, which really ties in with, it's not quite the close. Pretty close to the close from the other day. We're not going to carry that over. So the high at Globex, that would put us outside of yesterday's price action. So we'd have an inside day breakout at that point, and we would focus on reclaiming the pivot points from Friday, including 350 and the open at around 375. From our current location, that would mean that we regain the 0.5% that we're down. So a 1% move would put us at around 43.50. And if we ended the day at over 2%, we could see the close or the open from Friday. Again, I find it unlikely that would make such a move in a single day at this point, unless we have really good econ and everything would light up. You'd have strong financials. The fangs would be moving to the upside. You'd have tech behind us. You would need to see a continued move lower in the VIX. We want to see all the other sectors start to come into play. You could have one or two sectors that are kind of dragging its feet, but otherwise you would need all of the other sectors to come in. So again, it won't be subtle. All right, we're looking at a 10-day, 30-minute profile, and you can still see that we are outside of the box. There is some volume resistance near our own Globex high, so right around that 4,300 area. We're beginning to move away from the box again, which is noteworthy. You really want to pay attention to it. Generally, when we're outside of the box, we have no expectation of a market doing anything more than trying to get back into that box. And that's not what we're seeing here, right? We're continuing to fade away from that box. Also, it's worth noting how narrow and tight the range is on that box. It's a very, very tight range. The point of control is still a long, long ways away, and it's not even to the midpoint of the box yet, right? Every day that goes by that we stay outside of this, it's going to slowly bring that point of control down. If we do get above 4,300, we've got a nice shallow area, no form of resistance on the volume to uh, be noteworthy or to get our attention. And only until we get back above the box do we see any form of volume resistance at all. So that'd be back above 43.70. There is still the untouched point of control at 43.35, which we already had marked out. And now there is also an untouched point of control at 42.33. All right, so we're looking at the Nasdaq. Same thing. Want to come out to the higher time frame? Just take a look around. You'll never know if there's something out there if you never go look. Nothing out here that really gets our attention that needs to be addressed. Just take a look. Kind of more out of habit than anything else. It's worth doing though. Uh, Sometimes there's something that gets your eye you didn't even know you were looking for until you go out there, right? So again, here the IB is really tight. It's the assumption that there's still a lot of work to be done or ammo left, right, in the chamber, that there's still uh, transactions that can transpire that have not yet taken place. So a very muted, very narrow range on the IB. It is possible that we maintain our range day. That would be from the Globex high to yesterday's lowest point. That's a very tight box for the NASDAQ right now, basically from 13.5.5 down to 13.200. It is possible that we stay there. I just don't believe it. Right. So it is certainly one of the scenarios, one of the things that could happen. I just don't believe that that's going to be one of them. Right. The other two scenarios, what else could we do? Well, we could break to the upside and make aggressive moves to try to continue to reclaim these previous levels. Or we could rally, or we could fade back down, break previous day's low, and continue that move down from there. It is noteworthy to note that the big FANG names are very likely going to impact this in a significant way. So we may stay quite muted until those earnings come out. For a bullish move, we'd first have to get back through our own Globex high. Then we would focus on yesterday's Globex low. But those two are really, really close together. I would consider that more of a zone than anything else. Taking off our own Globex high and using Friday's Globex low would have more weight. From that, we'll focus on Friday's open and then Friday's Globex high. That would put us at 13,800. We've got a 2.6 ADR. And from our current location, a move like that would be about a 2.4 if you take away what we've already moved, right? We would first need to get back to zero. That'd put us at about 1.8, I guess. from zero. It is within range. Just find it. It won't be a slow grind, right? It'll be just like we were talking about. You'll see everything lit up. It shouldn't be like that choppy um, mess from yesterday. We did, finally get going towards the later part of the day, but in the first part of the day, it was just a chop fest. It was definitely a difficult trading day. Downside move would be the same scenario. We first have to get through our own Globex low. We would then focus on the open of yesterday. Now, before we even get to the open, we would have the Globex high from yesterday, then the RTH open. You could mark the Globex open, but I think it'd just be too much clutter. There could be a reaction worth noting, right? It is possible that the price responds at that level. The Globex open. You can see how it's pretty close to the Globex high. Yeah, just keep the Globex high. And then yesterday's Globex low. That's our likely scenario for the downside. Still want to give it that measurement and kind of see if we're maintaining within the ADR. So we got a 2.6 ADR, and getting down to the low of yesterday is within range. It's 2.35 from our current location. We're already down 0.4. That would put us at about 2.7 ish. So pretty close, right? Very, very close to the ADR. So it's within reach. It's well within reach. Looking at the volume profile, you can see we are outside the box. The box is very narrow, but the point of control is more closely centered than on the ES. There is some volume resistance around 13,700, but nice shallow area from our current location up to that area. All right, so if this volume support holds where we're at, 13.45, 13.46, right around in there, if this holds and we continue that move to the upside, we don't have a lot of volume resistance to deal with, right? It gets nice and shallow all the way up to that 13.7 area. All right, because of earnings and everything that's on the table, I'm going to go back through something we went through the other day and kind of just get people's attention to how far this market has really gone. And so we're looking at Apple, and we've got a 1-year change percent, right? So we're talking about from the far left to the far right, and you can change your chart to price as percent and kind of just validate. And you always want to do this with Thinkorswim. Don't trust those change indicators. They can be off, right? I point this out like every Monday on the streams, that you have to really pay attention to where the change is being started at. So always check, right? You can see the chart says 20.9% and the label says 20.9%. So we know, okay, it's doing its job. It's functioning correctly. That way, if you don't have change percent on the side after the first one that you check, it doesn't matter because you know that it's functioning the way it should. Apple is down year to date, but it's up on the year. It's a distinction between those two that are very important. I'm going to change this time frame to year to date. Now we've got price as percentage on the side here. You can see that we're down 10.5% on the year, but we're still up year to date by 20%. That's Apple. So if we're talking about the fangs getting beat down, take a look at something like Netflix for 12 months, down nearly 60%. 60%. Year to date, just since January, 64% to the downside. Spotify down 62%, down 54% since January. Facebook down 38%, down 44% since January. PayPal down 67%, 50, we'll call it 55 since January. The reason we're going through and looking at these is because there are some names that are not beat down this bad. Things like Google that are still up year to date, even if they are down on since January, right? So for a trailing 12-month or a 1-year look back, it's still up on the year. It's just not up year to date since January. Microsoft, same thing. It's still in the positive on the year for a 12-month, but it's down since January. So why go through and look at these? Well, these are the last bastions of tech that have still held up, right? When they talk about the double popping and recession and the collapse of the market, all those bobbing heads on TV that always talk about the end is coming and watch out, everything's a big bubble and it's all going to pop. Bubbles don't pop all at once. First, you get the small caps. You get all those bubbles popped, and then they start moving on to mid cap, and then they go into large cap, and now they're focusing on the mega cap, right? And you're starting to see that there's really not much left, right? There's nothing really beyond that. Tesla's up 35% over the 12 months, but still down 16% year to date. So these FANG names, they're really the last ones that are holding us up, right? Remember, they have the weight and the capacity and the strength to move this market on a day-to-day basis. They do move this market on a day-to-day basis, right? That's literally what is shaking us around every day. So we're talking about some of these really big names coming out with earnings. Tesla survived its earnings, right? It didn't do amazingly well, but it didn't crash and burn. But Tesla's not Microsoft. Tesla's not Apple. And Tesla or Microsoft and Apple are the darlings of Wall Street. It's in every 401k, it's in every retirement package. And we're talking about those pre-packaged, hi, I got a job at, UPS and you're going to have my funds managed by JP Morgan or whatever. And they look at your age and they look at your health and your goals, and they put you in this retirement box, this investment box, and they say, okay, well, here's your box. You got 40 years of till retirement. you're mildly aggressive, we'll get you into some bonds, we'll get you into some utilities, and oh, by the way, you're going to have Microsoft and Apple in that portfolio. Everybody's got this. Everything focuses on this. If we start seeing this run, start to see a route here, there won't be anything else, right? So that's why it's important today to keep track of what's going on out there, that it's not going to be just the candles, right? It's not going to be just the news of the econ. It's going to be these FANG names today. All right, so we got oil bid back up basically to where we closed yesterday. We got the dollar testing a new breakout. We at least have a micro double top. We have a larger double top and an inverted head and shoulders in the bonds. It's really nice to see that those things are maintaining that regression back up. Bitcoin's been running kind of flat, which has been a really oddly valuable image of our current market. It's been that way for the last few days, and it's been a leading indicator on strength and weakness, giving a nice heads up on the day. Gold did finally seem to stabilize yesterday. It tried to bid back up a little bit, maybe more from mean reversion than anything else. Keep your eye on the dollar and the bonds. They're going to really have a lot of impact on our market overall. The VIX is still not responding to, the current situation out there at all. It's been a real dud, honestly. I have no trust or faith in the VIX right now. If you want a more immediate, very responsive VIX, think of it as like a very, very small moving average. You can put on a 9-day VIX. There's UVXY. This is an ultra and a short term, very responsive. The VVIX, this is like the volatility gauge of VIX. How volatile is the VIX right now, right? Because you can't put on an implied volatility indicator on the VIX. It wouldn't make any sense. This is what we would use, right? The VVIX. Now, if you look at the way it was reading pre-COVID, we used to maintain below that 110 level. And when we got above that, we would consider it extreme volatility, right? You can see there was periods in history where we would get above it for 2 or 3 days and we'd come back down. And it would be very impactful and very important every time that happened. Well, we need a new extreme level. It's very likely going to become something like the 150. And that if we are below the 150 and say maybe more of below the 130, that we would consider it our more normal, right? It's hard to believe that that would be our new norm, but that's the reality that we live in. I was going to show you guys something. I can't find it now. I guess I will find it later. Later when it doesn't matter. All right, move on then. Okay, the sectors this morning. They need to move at least 0.5% before we even consider them to be moving around at all. Financials are down more than 0.75%. Airlines, transportation, which is a real big deal, down 2.25%. Tech is pretty close to that halfway mark, but isn't there yet. And biotechnology is down near that halfway mark, but not quite there yet. On the positive side of things, kind of take it back in the other direction, energy, Bitcoin, bonds, natural gas, cloud computing, marijuana, oil, home construction. Gold is a little positive, but not yet at that 50% mark. And some of the financials, the banks, are near that, kind of in between half and a quarter. But they're moving in the right direction. What those don't cover, though, the 11 legacy sectors of the S&P, they don't cover things like the electric vehicles sector. If we were to make our own sector, we can see we've got a few names that are legacy, like GM and Ford. Ford's up nearly 1%, and GM is basically flat. Ford does have earnings. NIO, 0.75%. XPEV and FSR below half, but moving in the right direction. Liato, 1.25, more 1.5%, and then Ride over 2%. Tesla is basically flat this morning. So that covers the EV. Take a look at semis. Everything is down. Every single semi name is down this morning. With the airlines, God loves up earnings. Otherwise, the rest are either flat or, looking at the ETF jets, really flat. Right? Negative 0.8. For crypto. Now, this crypto list, it obviously isn't crypto names. It's companies that are either heavily vested in blockchain or heavily vested in coin. So you'll see things like TSM and NVIDIA, PayPal, AMD, Square, right? So it's looking really good. A few names that are down are a few that I mentioned, like TSM. It's part of the semis. And the pot stocks. You really want to break those out instead of just looking at the MJ ETF. You want to break those down into what category, right? Is it recreational, medicinal, more of the oils and CBDs? It matters because there's even like real estate for the marijuana sector, XXII, right? So when you see that they're up or that they're down, just like with finance, it's not just a blanket statement of, oh, well, finance is up or finance is down. This morning is a great example of that. Some finance is up and some finance is down, right? Like regional banks are up this morning. But odd stuff gets put into the financial names, like insurance. Things like Aflac and other sectors like that are still considered financial, right? Other industries like that. So it's always worth breaking down a little bit more and kind of digging a little deeper. there are plenty of names that continue to be green to have opportunities most days, right? We were highly correlated last Thursday and Friday, so there wasn't a lot out there. But on a day to day basis, most of the time you can find some green out there. These two watch lists down at the bottom are a glimpse of all companies that have weekly options. That's literally the only criteria for them to be on this list is that they have weeklies. And you can see that I have to scroll a long ways before I get out of the green, that there are plenty of names that are positive out there. And this list is 600 names long. The only reason you see two columns is I can't make one watch list on TrendSpider with 600 names in it. I had to break the list in half. And each list, I have to scroll a long way to get out of the green. So there's plenty of positive names out there if you want to be bullish. Of course, you don't have to be bullish, right? All right, open to butterfly on XLU, a butterfly on UPS, and a butterfly on Tesla. Those were all yesterday. You can see some of these, I mean, it's really cheap. Got one on UPS for 5 cents. Cheap, cheap. Right? I guess that was a vertical on XLU, not a butterfly. So a vertical on Tesla, a vertical on XLU, butterfly on UPS. UPS is for this week. The Tesla is for August 19. Notice it's a $78 vertical on Tesla. I mean, that's crazy cheap, but it's because of how far out of the money I am, right? I used the 300 and the 350. This is like a lottery ticket, right? Go to the gas station, scratch it off. Maybe you win, maybe you don't. It's a little on the expensive side for a lottery ticket. It's a $78 scratch lottery, but it's a $50 wide put spread for August. And this is not a credit spread. It says debit. It's green. It's a debit spread. So this trade needs Tesla to go down if it's going to make any money. The idea is if Tesla was to make an exaggerated move to the downside very fast, it doesn't need to last for very long. It would just be a fast, hard drop to the downside. Say earnings goes bad in the fangs and it drags the market down, including Tesla. If such a thing like that was to happen, I could roll this August 19 trade forward in time to say less than 30 days to expiration, and I would be able to lock in the profit to where I would hold this trade at that point for free, and I wouldn't have any risk left on it. And I could just leave it on and see where it goes for the rest of the time of its life. Right? I would get my $78 back and lock in a no lose spread. So I'm not looking to keep it. It's really just because of the situation with earnings and everything else. And if we don't dump, right, if earnings is good on Microsoft and Apple and the others, and we don't dump, then I'll probably manage this, convert it, flip it, do something else with it, maybe get the short leg back and take it forward in time and start selling puts against the put that I own, right? So starting with a debit spread, but I'm willing to rip this thing apart and turn it into just a put and then sell puts against the put that I have. For the XLU, it's a $1 wide spread held for 20 cents. So I'm basically risking $20 to make 80. 80's max profit and 20's max loss. And I'm not under the impression that I could actually hit max profit. So I'm probably not going to give it a max loss either. Right. I'd probably be willing to risk, say, 3/4 of this. So that'd be 15 cents on the assumption that I could make at least 50% of its max profit, which would be 40. Right. So now I'm risking 15 to make 40. It's still better than a 2-to-1. It's not bad. The reason I'm pointing it out is that there's always something, right? There's always something out there that you can focus on. even if you want to be bullish, I had someone reach out yesterday, and so they just weren't comfortable with the idea of buying calls or puts and then selling against it. They said, "Well, what else could I do? I still want to use verticals." Okay, do that. But instead of putting on a put spread under the market because you think you're bullish, if you're bullish, put that call spread on top of the market, not in something like Apple right before it has earnings, right? Pick something that's not such a big mover. And even if you're bullish, just go above that bullish spot enough that if it does rally, it doesn't run you over. Look at something like X Steel. So the way that I like to play this, maybe something else. Okay, yeah, okay, take Visa. So if I was bullish in Visa and Visa happened to be sitting near its highs, you can still put credit spreads above that, right? Call credit spreads, give it that bullish room to run. And if you're wrong, if it doesn't stay bullish and if it doesn't go up and instead falls down, your call credit spread is going to pay you even faster. If you're bearish, you're looking at markets to go down, put the put credit spread on, just give it room, give it enough room so it doesn't hit you, right? It's the same trade that we do in the SPX on the 0 days. For anybody who's watched my videos on the 0 days where I talk about I want to see a 0 day where we've already made it a big move in one direction, right? If we've already moved 3% in one direction and I'm getting ready to put a 0 day trade on, I like to go even farther away in the same direction and say, oh, wow, you've moved 2%. I bet you can't move another 2% and hit me at that point. And that's where I put my trade on. I don't try to go above the market and say, oh, wow, it's already moved 2% to the downside. Let me put on a call credit spread 2% above the market and see if it'll fall even more. Get in front of the market. Say, I bet you won't run another 2% hit me. Well, take that same logic and take it out to the higher time frame. If you're bullish, continue to use the call credit spread. Look at the expected move. So if we take something like, oh, what's everybody been talking about? Everybody talks about AMD all the time. So let's use AMD, right? So we're looking at something like AMD. This one has been traveling to the downside. We could have the expectation that it's going to continue that move to the downside. So say I'm bearish, I would want to put on a put credit spread, but I would want to not get ran over, right? So then we go and we look at AMD, the expected move, 24 days out or so, around 30, right around in that window. It's got an expected move of $15. We'll just round up. So if I was to put on a put credit spread, $15 away from our current location, lower than our current location, the put spread would say, yeah, I'm still bearish with you, but I bet you won't hit me, right? Now, these kind of credit spreads, if the market does continue to move in the direction that you think it is, they're not going to win very quickly. You're going to be stuck in them waiting. But if you're wrong, if you think the market's going to go down and it starts to go up, that put credit spread will win very fast. You'll be able to get out of it very quickly because it will hit your profit very fast and you'll be able to move on. If you're actually right and it moves towards you, it may lock you into that trade for a while, but theta will override price action and you will be able to close it profitably. Right. So, it takes the same logic that we've been doing, flip it over, put it on those higher time frames. A little note of caution that I'll continue to stress: when we're sitting at the lows, this is not the time to put a call credit spread on right above the market. So don't use this discussion and go out and put those call credit spreads on when we're literally sitting at the lows. The same thing with the put spread. If we're sitting at the highs, don't put the put spread on when we're sitting at the highs, because that's where the market generally makes those big moves, right? If we've had a big move to the downside, then it's very likely going to have a mean reversion and reciprocate back the other way relatively quickly. All right, everybody, be careful, be safe. I'll see you all tomorrow.